Robert Parker, Senior Advisor at Credit Suisse, joins in on the show right now. Robert, hi, morning. Asian equities as well as currency have really been reeling under pressure, and that was the case yesterday as well. Do you expect this kind of pressure to remain?
Well, clearly, the ending of quantitative easing, although it is very slow, and although real interest rates, if one looks at the Fed funds rate minus inflation in the United States, although real interest rates will remain negative, clearly the ending of quantitative easing, although it's only going to take place slowly over the next year, clearly is a negative factor and has been quite rightly interpreted as a negative factor for global equity markets. And I do think that it means two things. First of all, the overall market volatility increases, albeit market volatility was at a very low level earlier in this year. And secondly, it does mean that those markets which are very dependent upon liquidity and particularly injections of foreign capital are more vulnerable. So I think as a result, we've seen particularly a hit to emerging market debt, and that's where investors had major long positions. And because we've seen the reversal in emerging market debt, that obviously has had a negative impact on Asian and emerging equities.
Robert, so do you see that a lot of value has emerged in emerging market countries like India?
Well, I would argue that value is actually starting to emerge, and I think one very important point to make is that if you look at virtually all equity markets today, valuations are reasonable, and obviously after the setback, most notably in emerging markets since the third week of May, and given the fact that a number of emerging markets, notably Brazil, Russia, China, and to a lesser extent India, are all in negative territory year to date, valuations are starting to look attractive. Now, obviously, one has to then ask the question, well, is there going to be a catalyst which is going to lead to an improvement in markets? And I can probably list a range of catalysts which will emerge later in the year, but I think in the short term, we probably trade at these current fairly low levels. In the short term, I would mean the next 1 to 2 months.
Robert, one of the assumptions for funds to be bullish on India was hopes of monetary easing. Now with the currency collapse, these hopes are pretty much dashed. How would you advise investors to play Indian financials then?
Well, clearly one factor behind the expectation of further monetary easing in India was the improvement in the inflation rate, plus obviously the need to kickstart growth, and that was after yet another first quarter growth number less than 5%. Obviously, there is still a need to keep monetary policy reasonably easy, given that we need better evidence that growth is going to move back well above 5%, and frankly, that evidence isn't there yet. Obviously, the Reserve Bank of India has a particularly difficult challenge at the moment because, first of all, the weakness in the currency, with the currency decisively through 60 against the US dollar, that has a negative impact on inflation. Plus, let's not forget that recently oil prices have moved back up, with WTI now well above $100 per barrel. So that commodity plus currency effect means, I think, inevitably that we are going to see poor inflation data over the next 2 to 3 months, and that means that the RBI cannot ease monetary policy further. I think, however, given the weakness in the economic data, the RBI will be very reluctant to tighten policy. So I would argue policy is probably on hold in the near near term. Obviously, for the financials, that means that there is a risk of the financials underperforming. The offset to that, of course, is that with the weakness of the currency, Indian exporters are now very competitive, and therefore I think you'll see a rotation out of domestic sectors into the export sector.
All eyes are now on Fed meeting, Fed minutes of 19th July meeting and Japan's monetary policy coming up on Thursday. Do you expect more jitters, or do you expect both BOJ and US Fed are unlikely to do anything silly which will spook global financial markets?
Well, I think let's start with the Bank of Japan. Bank of Japan policy, I think, is very clear, which is that they are going to increase the size of their balance sheet to over 60% of Japanese GDP by early 2015. They are doing quantitative easing, which is the equivalent of around 70 billion US dollars per month, and obviously they continue with their near zero interest rate policy. So, I would be very surprised if Bank of Japan comes out, with any statements which move away from their already clearly stated policy. In terms of the Federal Reserve, I do think you are going to see statements in line with the expectation that quantitative easing is slowly tapered, and that tapering will start in September or October. Obviously, the market reaction to these statements, I think, is largely discounted, actually, and the market, I think, is now totally expecting this tapering announcement by the Federal Reserve.
Right, Robert, how do you see Indian equities performing for rest of 2013? Because the first half of 2013 has been a flat year for Indian stock markets.
Well, I think the first point to make, as I said earlier, is that volatility will increase. I think the second point is that valuations are now reasonable. The Indian market is certainly not overvalued. And the positive is that we will have probably negative real interest rates continuing, and we now have an undervalued currency. So I actually think that the downside risk is now fairly limited after this very lackluster performance in recent months. Having said that, I do think that we're going to need evidence of stronger corporate earnings growth and evidence that economic growth is going to move back well above 5%. Unfortunately, I think that evidence is only going to start to emerge in the fourth quarter of this year. So I think we could easily have, in the coming months, what I call a stop-start market, i.e. that we have increased volatility, but with no discernible trend, and that we flatline over the coming months.
Robert, good chatting with you. Really appreciate you taking the time out and joining us.